Welcome back to The Breakdown with me, NLW. It's a daily podcast on macro, Bitcoin, and the big picture power shifts remaking our world. What's going on, guys? It is Monday, September 16th, and today we are talking about the SEC and its regrets. Before we get into that, however, if you are enjoying The Breakdown, please go subscribe to it, give it a rating, give it a review, or if you want to dive deeper into the conversation, come join us on the Breakers Discord. You can find a link in the show notes or go to bit.ly/breakdownpod. Hello, friends. Happy Monday. Today, our main story is about the SEC regretting its designation of crypto assets as crypto asset securities. But before we get into that, I wanted to do a quick macro update because we are 2 days out from the Fed kicking off the rate cutting cycle, and markets appear to be pushing for a larger than usual first cut. We've been tracking for a while now that basically as the markets have settled on the idea that there was a cut coming this week, the debate really was just whether they would go for a 25 basis point cut or a 50 basis point cut. All the way up to the end of last week, especially after a number of new economic data points, it seemed pretty clear that we were headed for a 25 basis point cut, at least that's what I said on Friday. However, something has changed. Fed funds futures priced in a 67% chance of a 50 basis point cut overnight. Now, keep in mind that the market-based odds of that had narrowed to just 14% last Wednesday after the release of August inflation numbers. That data, you'll remember, was relatively flat, save for a major uptick in shelter inflation. And in the immediate aftermath, analysis was mixed. Some suggested that shelter inflation was wildly overstated, while others noted a lack of further progress. What was clear was that the inflation data didn't provide a clear direction for the Fed. There was no consensus then on whether the central bank should cut by 25 or 50 basis points, and analysts broadly spoke to their own bias in the absence of clear data. Friday's weekly jobless claims data was just as unclear. New and continuing claims increased marginally but came nowhere close to signaling a recession. With no clear signal in the data, some turned to Nick Timiraos of the Wall Street Journal for direction. Timiraos is a known Fed insider and often clears up ambiguities ahead of FOMC meetings. Alas, his Thursday article provided insight but no clear view. He wrote, "The Fed normally prefers to move in increments of 25 basis points because smaller adjustments give them more time to study the effect of their policy changes. Some officials have suggested they would rather speed up the pace once the economy looks like it is weakening further. Alternatively, officials could conclude that if they expect a 50 basis point move is likely in November or December, they ought to make that move now, when rates are farthest from their ultimate destination." He also pointed out, though, that a 50 basis point cut would set expectations for another jumbo cut in November, which the Fed might not want to do. John Faust, a former senior advisor to Fed Chair Powell, said it was a close call. He claimed the number of cuts were more important than the size of the first cut, adding, "I don't think we're in a spot that really shouts out for a preemptive 50, but my preference would be slightly towards starting with 50, and I still think there's a reasonable chance that the FOMC might get there as well." These comments might have reinforced the idea that Powell will push for 50 when the FOMC assembles later this week. Another angle is how markets would read a jumbo cut, which is once again the subject of contradicting takes. Some warn that markets would freak out. Lena L-Deeb, a research analyst at 21 Shares, wrote, "A more aggressive rate cut could shock the markets, given that it would ring alarm bells for a recession. Investors would trade cautiously into weather market conditions, which could hurt risk-on assets in the short term." Others, though, have pointed out that a 50 basis point cut would accommodate markets that have been constrained for over 2 years. Johns Hopkins economist Steve Hanke wrote, "A 25 basis point cut is already anticipated by the market, which means the actual cut might underwhelm, triggering a sell the news response. In contrast, a 50 basis point cut is not factored in. If it were to materialize, it would probably give the market a lift." Greg Ip, the chief economics commentator at the Wall Street Journal, had a more nuanced take, tweeting, "I think the Fed should cut by 50 basis points. I feel we overanalyze each data point for what it means on timing and size of rate move rather than ask what level of rates is appropriate. I think it's obvious the right level is well below where we are now. Real rates, which is the gap between Fed funds and the inflation rate, are currently at multi-decade highs. This means the Fed should have plenty of room to cut simply to normalize rates without implying that they're fighting a recession. Simply the fact that markets are now pricing in strong odds of a double cut might be enough to get the Fed over the line. The Powell Fed has avoided taking markets by surprise almost to a fault. An adjustment in market positioning reduces the stakes, allowing the FOMC to simply endorse what is already priced in. It also likely reduces the risk that markets will be spooked by a jumbo cut, considering they are already positioned for it. Bloomberg economist Anna Wong commented, "If these odds continue to swing in favor of 50 on Monday, and the gap opens up, even if there is no additional Fed signal, I think we have an answer." The meeting will also set the pace for the final quarter, with Zahir of Split Capital tweeting, 50 basis points on Wednesday would be wild. Recall this Fed meeting is more important because of the dot plot that is attached showing where various members of the Fed stand. Forward guidance for the remainder of the year. Then again, financial plumbing expert Conks thinks we're all vastly overthinking the move, tweeting, 25 basis points cut, bullish. 50 basis point cut, also bullish. Hope that helps. So a nice little bit of intrigue right at the end of this cycle. Of course, we will get our answer in just a couple of days. Hello, friends. Before we get back to the rest of the show, I want to implore you to join me at Permissionless. Permissionless is the conference for crypto natives by crypto natives, and the reason it's so important this year is that despite regulators' best attempts to push industry founders, devs, and executives out of the US, the United States remains the beating heart of crypto. Today, the tide is turning. Policymakers have pivoted from fighting crypto to embracing it. Literally now we are in a major political party's platform, which will lead ultimately to the creation of new financial products, new applications, and ultimately new adoption. Permissionless is the conference for those using and building on-chain products. It's home to the power users, the devs, and the builders. And perhaps more importantly, I will be there. The location is Salt Lake City. The dates are October 9th to the 11th, and tickets are just $499. If you want to get 10% off, use code BREAKDOWN10. Go to the Blockworks website, blockworks.co. There will be links to register for the conference, and again, you can use code BREAKDOWN10 to get 10% off. Now to our main topic. Speaking of overanalyzing things to death, one of the tools of the SEC has been language. But now, one part of their language path has apparently closed. The SEC has officially backed away from the term crypto asset securities. In an updated filing in the Binance case, the SEC said they never intended to imply that the tokens themselves are securities. Rather, the regulator claims they always recognize that securities law only applies when the circumstance of a token sale meet the Howey test. As a quick reminder, the Howey test holds that an investment contract is an investment of money in a common enterprise with an expectation of profit derived from the efforts of others. In a footnote to the filing, the SEC said the term was always meant as a shorthand. They referred back to the language of the Telegram lawsuit in 2020 when they explained, quote, "While helpful as a shorthand reference, the security in this case is not simply the crypto asset, which is little more than alphanumeric cryptographic sequence. The security in this case consists of the full set of contracts, expectations, and understandings centered on the sales and distribution of the crypto asset." The regulator said they were no longer using the shorthand term in the Binance case and, quote, "regrets any confusion it may have invited in this regard." The SEC made it clear they are not arguing that a token carries the securities designation in perpetuity, even if an ICO was originally covered by securities law. This is relevant for the Binance, Coinbase, and Kraken lawsuits, which all involve trading in secondary markets. With respect to the Binance case, the SEC claimed they are arguing that the token's, quote, "promotions and economic realities have not changed in any meaningful way under Howey, such that they continue to be offered and sold as investment contracts." The same filing expanded the number of tokens that were claimed to be traded as securities to 10. The list in the Binance case now matches the Coinbase and Kraken lawsuits, including Solana, Filecoin, and Decentraland's Mana token. The SEC is largely focused on the BNB token, though, as they only need to demonstrate that a single token is covered by securities law in the secondary market. They claim that BNB was originally, quote, "offered and sold as a security." Further, they urged the court to consider ongoing promotions and the economic reality of transactions that, in their view, quote, "make clear that the post-ICO sales of BNB, including between investors on the Binance platforms, satisfy Howey." We've seen the language used by the SEC slowly change over the years. Back in 2017, the regulator published their first guidance on crypto tokens, known as the DAO report. Their contention at the time was extremely clear, with one section titled, "DAO tokens are securities." The next evolution came after the SEC's case against Ripple turned against them. For a brief moment, the SEC claimed the ecosystem present on crypto networks was a form of investment scheme. They claimed the tokens represented a way to buy into this scheme and embody the investment contract. These arguments were finally killed off last month in a ruling in the Kraken case. The judge warned that to the extent the SEC were arguing that tokens are securities or embody investment contracts, quote, "its argument cannot proceed." Since then, the SEC began to refer to tokens being bought and sold as securities. The eToro settlement announced last Thursday contained this new language in the press release. However, the settlement order filed with the court referred to crypto asset securities 8 times. Crypto lawyers, for their part, could not believe how disingenuous the SEC was in claiming they had, quote, "consistently maintained the position that the tokens themselves were not securities." Coinbase chief legal officer Paul Grewal noted that paragraph 1 of the Ripple lawsuit claimed that XRP was a security, adding, "Gaslighting the American public is bad enough, but the United States government misrepresenting themselves to a court in this way is something I've never seen in 28 years in the law." Jake Chervinsky, the chief legal officer of Variant Fund, tweeted, "The SEC finally addresses criticism of its nonsense term crypto asset securities by, checks notes, lying about and abandoning it? So the SEC is going to amend all its other complaints to remove that term now, right? Right? I genuinely cannot get over how insane this is. The SEC has officially jumped the shark." Catherine Minerick, the chief legal officer at Uniswap Labs, pointed to the awful public policy implications, commenting, "Truly, whether or not you care about crypto, if you care about fundamental fairness in our legal system, then you should be deeply concerned about the SEC's approach to crypto. No government agency should work this way. Government agencies are trusted with enormous power to enforce laws, which is why they are required to give us all notice of their views of those laws before bringing the full force of the government against any of us. But the SEC is not just inventing new theories of how to apply securities law in its crypto cases as it goes along. It is contradicting itself with those theories, sometimes within days or hours, often within the same courthouse. The SEC has active cases right now premised originally on legal theories that it no longer stands behind when pressed. But instead of dropping those cases, the SEC moves to a new theory and continues on. Minarett goes on to make it clear why these shifts in language matter. Each shift has come as a response to pushback from the court. This whole language change around crypto asset securities only happened after they got spanked. Rather than going back to the drawing board and making clear rules, the SEC decided to revamp the language and reframe their argument. The language matters because it creates the impression that the SEC's jurisdiction is clearly established. By claiming that tokens in general are, quote, crypto asset securities, the SEC packaged up a jurisdictional claim into an easily repeatable phrase. That phrase is still being used across SEC communications, such as a social media post published on Thursday that warned of scams involving crypto asset securities, end quote. At this stage, the language shift is only in court filings, so we'll have to wait and see how the judge responds to the goalpost shifting again. Stuart Alderati, the chief legal officer of Ripple, pointed out, Ripple's case is over, but the fair notice defense is still alive for others. The SEC cites the 2017 Dow report as industry notice that crypto asset securities are subject to U.S. securities laws. 7 years later, the SEC apologizes to a federal judge, surely a person of at least ordinary intelligence, for the confusion it invited by using the inherently unclear term. Regardless of which term is used, the SEC will still need to prove that sales between third parties in the secondary market are somehow investments in an investment scheme. They struggled to do so in the Ripple case, given that Ripple didn't receive any money from secondary sales. The Binance filing is focused on marketing and sales materials that promoted tokens as investment opportunities. The SEC claimed that the economic realities of the investment scheme were unchanged, even though the tokens changed hands between third parties. Basically, my TLDR on this is that the central issue and the thing that has been frustrating to everyone is the SEC's approach to regulation by enforcement. This has been their mantra and their approach for years now. The industry bristles because it argues that the SEC has not been clear about actually articulating its theories, for example, of what makes a crypto asset security a security. Instead, they do things like label them crypto asset securities, hoping that the language will take, and that it will somehow add weight or be a self-fulfilling prophecy that people just start to think about these things as securities. The fact that it takes a judge smacking them down every single time is part and parcel about what's been so frustrating. We don't have the normal rulemaking process to go through, so all we have is court battles. Now, those court battles are increasingly ending up in favor of the crypto industry. It feels like part of the game might just be dragging it on for so long that it suffocates and dampens enthusiasm so fully that the SEC gets its wish that crypto not exist at all by sheer inertia. In other words, this is just a glaring example of tactics that are ultimately not about investor protection, but instead about killing an industry that the SEC does not like. Good news is the fights keep going against them. But boy, is this frustrating. Anyways, guys, that is going to do it for today's breakdown. Appreciate you listening as always. And until next time, be safe and take care of each other. Peace.